welcome all of you to our kickoff panel discussion at our events around the IMF World Bank meetings. It's a great pleasure to welcome all of you to the IIF annual membership meetings. I can't remember a time when people and markets have been as confused about where we are as now. I talked to many people who basically are, number one, focused on recession, mostly in the United States, so that'll obviously be a topic that we're going to discuss here. Then, obviously, the on-off-again tension on trade with China is a huge preoccupation. Tweets, obviously, are a big focus. And I think the main question people have is, if we now go to a stalemate, so we don't have new tariffs, but we don't have rollback, then is the underlying momentum in the United States economy and the global economy enough to sustain us through continued expansion and avoid recession? So if we have just a stalemate, a truce, is that something that is good enough? And then finally, emerging markets have just been, for value investors, appealing. They keep getting cheaper and cheaper, but they are not rallying the way that you would expect in a Fed cutting cycle. And so these are just some of the topics that we're going to touch on. I'm going to start with a question on the global economy. You all can direct questions at us, so please do, and I'll feed them in through the iPad that I have here. But maybe we can just start on the global economy and the United States economy, recession risk. Where are we? How vulnerable is the economy, Catherine? Can I start with you, please? What are you seeing in the data? How worried are you? When I got up this morning, my anxiety level was quite high. How high is yours?
So I think where you started was we're all kind of very confused. I think one of the reasons why we're very confused is that the state of the economy, both the global economy and the U.S. economy, really depends on who you're looking at. If you are a domestic firm providing a service to domestic consumers, you're looking at the best situation that you've had in decades. And this actually is true not just in the US, but it's true around the world, even in Germany. Less so in Germany than other places, but still, if you're domestically oriented, a consumer oriented, a service provider, even a B2B type service provider, you're looking at a fabulous economy. If you're a manufacturer, part of a supply chain, particularly associated with China, you are looking at a terrible economy. And so not only are the firms looking at things very differently and coming up with very different points of view, depending on who they serve, but the financial markets as well are similarly focused on to what extent am I focused on inequities, which is, there are some winners out there. There are definitely winners out there. Whereas in the case of the bond market is always, since it doesn't get any residual, it's always going to be much more concerned about the downside risk. So the divergence in economic performance and economic prospects, depending on what you serve and what you do, is really playing into this uncertainty. Now, how that translates into recession risk is exactly the same thing. We have several different models. Everybody does. I mean, it's sort of a cottage industry to have a recession model. But one thing that you take away when you have this menu of models is the more real side indicators you have in your model, the lower your probability of recession next year for the U.S. And one that has a balance of real side indicators and financial indicators comes up with something that's around 20%. But if your model is fundamentally driven off of financial side indicators, you're ending up with a much higher probability than that. And so where we come down is a real question about prospects for 2020 is this divergence between the prospects for the real economy versus what the financial markets are pricing in, particularly the bond market. How does that divergence close? You talk to the bond market guys and they say, basically, we got the money, we win. And so the convergence will be in a very unfortunate direction.
20%.
But others are not so sure about that.
20% makes me feel less anxious.
Yeah, I mean, there's, where there are a range of models out there and a range of other, of colleagues. I'm sure that our colleagues out there, the numbers for most people are well below that. But if all you look at the financial markets, you're going to come up with something much higher.
Paul, can you help me out? Feel less anxious?
Robin, I'm going to make you more anxious, but let me just first thank the IAF for inviting me. We've got our recession model for the U.S. Now. We're up to 35%. Depending on which side of the bed you get up on, that could be a no recession probability of 60 to 65. So if that makes you feel better, we can frame it that way. I guess in terms of what Catherine just said, and I agree with the kind of duality we're seeing right now globally, where we've got weak manufacturing and trade and strong labor markets and household spending. I think that's a little bit of an unstable combination. So I think what we should be watching in the next year or so is, well, one of two possibilities. If we continue to see strong performance in the labor market, people think they're going to have jobs, households continue to spend, then manufacturing is going to have to respond to that, right? So we've seen weak PMIs and weak IP data, but if households are continuing to spend, inventories will be run down, so manufacturing is going to have to come up. That's a scenario that keeps you happy. If, on the other hand, this weakness we see and all the uncertainty about U.S.-China trade and other stuff starts to filter into consumer sentiment, and we see households pulling back, maybe the labor market weakens, then we go into the downside. But I would say over the next couple of quarters, that kind of combination doesn't look particularly stable to me, so that's got to resolve as well. Different resolution than what Karen said, but I think that needs to resolve as well.
Gotcha. So, I mean, obviously, we've had central bank easing, right? And we've had 2 cuts from the Fed. We've got a restart of QE from the ECB. Brian, what should we expect? Markets are obviously pricing more cuts from the Fed. What's the terminal point here? How big of an easing cycle are we in? And then, given your background, I have a special request. Can you explain to us the economic significance of the repo market disruption and what is going on already?
So sure, on the policy easing, of course, the Fed has taken 2 steps already, is likely to take another step at the upcoming meeting. I don't think that's actually very aggressive so far. So there are a lot of people talking about this easing cycle in terms of taking out insurance against bad outcomes, or being aggressive given proximity to the zero bound. I actually don't think the Fed has done any of that. I think the Fed has no insurance so far. And I say that because I think just the shift in the expected outlook for GDP, given the drag from trade, is sufficient to justify 2 or 3 rate cuts. So policy is well calibrated for that scenario where we have a moderate slowdown in growth. And if we see the more concerning scenario where this spreads into household spending and more recession dynamics, then we'll have a much more extensive easing cycle. So it's somewhat of a bimodal outcome. We either stabilize with one more cut, or I think we're going to go all the way to the lower bound. I mean, any pricing that suggests, well, the Fed might cut to around 1% or slightly below 1%. I mean, that's really no man's land.
Right.
If we have conditions bad enough to get to that, they're going to go all the way to the lower bound. As you noted, we've also saw easing by the ECB. We keep thinking they're at the limits of their policy, but yet this policy easing actually engendered a very large decline in European yields, and I think in hindsight was quite beneficial for their economic outlook. But I'll make the same mistake again and say I don't think they have much more room to do more from this point. So that was somewhat of a last gasp there in terms of an adjustment of financial conditions. And yes, they could cut once more, but I think given where markets are priced, you're not going to see that much of an improvement in financial conditions in Europe coming from ECB policy from here out.
So it sounds a bit like you're in the camp that monetary policy is sort of close to exhausted in a way, as far as the ECB goes.
Yeah, absolutely. Now, the repricing we've seen both in Europe and in the U.S. has been very important. I mean, so that was very productive in terms of what it achieved for financial conditions. But there's not much room left.
And on, can I draw you out on repo?
Oh yes, repo. Obviously, we had a major disruption in the repo market, and that's tied into a lot of Fed framework issues that a number of us have thought a lot about. We had a very we had a forceful reaction from the desk. I mean, we could debate whether that reaction was a day or two late, but big picture, they have the tool to address this. They did address this. I think at this point, with their decision to add reserves back into the system, we'll have a much, more robust baseline to go from. And we also know that the desk is there and ready to react if uncertain things happen. So I think at this point, we should think of, the repo situation as addressed fairly well. Does it have broader implications? I mean, I think no, given the fact that the desk responded. I'm sorry, when I say the desk, I'm referring to the trading desk at the New York Fed. Given that they responded and controlled it, I think the implications are limited. If it were left unchecked, of course, there would be meaningful implications for how treasuries are priced, or really how anything relying on leverage financing would be priced. But their ultimate control of the situation, I think, means that the broader implications will be limited. With maybe one exception. I mean, behind all this, there is it's a sign of these frictions in the financial sector, and particularly in banks' balance sheets. And we knew these frictions were there, but I think it's a clear sign of them. And this was a case that was very specific to repo, but maybe there's a broader lesson about that more frictions in the system, kind of allowing more abrupt adjustments in response to shock. So I think there's a bit of a hint of vulnerability, but there's not any major basic lesson in terms of repricing of assets.
Got it. Catherine, I just want to come back to you on the terminal point for central banks. And, there's a question about, is the easing warranted?
Yeah.
If it is warranted, then is the easing sufficient? What is the economic impact? And then obviously all of us in the context of these tweet storms are wondering what the political underpinning of all this is and the ramifications for central bank independence and so forth.
So, I mean, I think that what we really need to do is we need to think about the two-step process of a change in the policy rate, whether it be the policy rate in the Fed or the change in QE behavior strategy, the multi-pronged strategy at the ECB, or even what the BOJ is doing. So there's a change in policy, and it does affect financial conditions. There's no doubt about that. But then we have to ask the second question. The second step is, how does that change in financial conditions change the real economy or inflation? Which, depending on the mandate, it's either both or one. And so the issue that I think is most germane is there's no question we got policy rate to financial conditions. No doubt about it. Financial markets respond to the policy rate or the change in the economic package, the policy package. But the transmission channel from change in financial conditions to the real economy, inflation output or unemployment, that is really tenuous. You got to ask the question, we are already in dramatically accommodative conditions. What does an additional 25 basis points do for us? It really doesn't do much. It's not going to alter the strategy for business in the face of the trade war. Monetary policy cannot offset uncertainty. It cannot offset a supply-side shock. And in the euro area, plenty of credit, no problems with credit availability. So, their strategy is almost a backfilling strategy to try to reduce the consequences of the policies that they've put into place so far. So, my view is, this additional easing, it's not insurance. It's actually building up financial stress that ultimately will have to be unwound. This is the problem of the 2-year-old and the candy counter problem, that you give in once and you give in again, and pretty soon you're feeding candy all the time. The other problem that I see, and that we've sort of documented in our assessments, is you can look at this period of monetary policy ease as giving opportunities for the fiscal authorities to use the lower interest rate on sovereign bonds in order to do something from a fiscal standpoint. So monetary policy opening up fiscal space. And there's been some specific language in the context of the ECB about using the fiscal space, right? Using the fiscal space that we're giving you. But what we have found when we are economists, we've got 64 economists around the world. When we ask them the question of what does it look like, there's monetary policy and then fiscal policy stance over the medium term. The more monetary policy availability, the more opening up of monetary policy on fiscal space that we are giving, that the monetary authorities are giving fiscal authorities, rather than using it, they are actually using less. The expectation is that they will do less. So rather than there being a complementarity between fiscal and monetary policy being created by this environment, there is a substitution. And of course, that is very negative for financial stability, and it does nothing to improve the state of the real economy.
Right.
I just disagree with your policy
I know you
perspective.
disagree. That's why I came out after you.
Well,
I also worked at the Fed, so we're
the thing is, no one's arguing that monetary policy is so potent that it can easily offset any shock, any trade war shock, right? But I think it's an extreme view to argue that it has no potency, has no effect on the output. I'm pretty sure exports are still responsive to competitive measures in terms of the exchange rate. Yep. I'm pretty sure people still care about wealth. I'm pretty sure people still care about borrowing costs. So, in my view, that's not a reason not to use the policy. Maybe the difference comes down to whether you think there's a cost associated with the ultra-loose policies. If there's no cost, and I think the costs are limited, then even if your instrument doesn't work as potently as you would like, you're going to use it, as aggressively as you can. Whereas in your case, if there's a cost and it's not that potent, then you pull it back. But
I think there's a cost.
But I see a case to use it aggressively.
Can I segue to trade? But I'd like to have a discussion about what's really driving a lot of this, which is populism around the world. And we have had populist ructions. We obviously have been dealing with Brexit now for a while, right? So that's a symptom of populism. Germany has east-west, right? AfD. Italy has north-south. So the populism thing, and in many ways the trade frictions that we're seeing, are a symptom of kind of populist retrenchment. Heather, you input into many big investment decisions. What are the ramifications of this populism for investment? How should we think about them?
Well, I think this ties in very nicely from what we just heard from speakers to my left here, is that we think about what is the most important driving factor going forward is the fiscal and the debt limits, right? And when I model the fiscal limit of a country, there are two main areas I'm looking at. I'm looking at policy credibility and the macro environment. And so both qualitative and quantitative. And so yes, monetary policy matters. Yes, it matters in terms of looking at the current context of the environment we're in and looking at just the potential for growth, looking at the potential for external shocks, and to think about what visibility do we have for that particular investment that we're looking at. As for policy credibility, it's a very qualitative assessment. And that's the one thing that when I'm down here in DC, you see all of the focus on data and the quantitative modeling, and you look at the financial innovation and the sophistication of the models that we're seeing out there. One area that we don't see enough of is the qualitative modeling, and understanding how do we model governability. And over the last few years, that has become so key in just understanding the policy decisions that are being undertaken.
Right.
And so the framework that I think that I've applied, that I think you can apply to Britain with Brexit, you can apply to US with Trump, you can apply this to Mexico with AMLO, is that you have to look at the constraints that are facing these government policymakers. These constraints can be political, right? Looking at the domestic political legitimacy and credibility. You look at the external constraints and look at the trade and financial relationships dependent on their economic model. And that's why the US trade tariff, issues have mattered so much. And if you think about the most important factor, driving markets right now is the fear of a serious escalation of trade tensions between US and China. But if we think about the incentives in play with the US being an election year, should this really be rising, or in fact, should it be falling? And then lastly is the market constraints. And then just looking at the susceptibility to dollar scarcity and the dependence on foreign capital and the need for exchange rates to be able to adjust, in changing times.
There's a question from the audience here, which dovetails nicely into this, which is basically, what's the dollar outlook for the next 12 months? And we kind of touched on this in a, I'm not going to speak to it because of my sordid history on the topic, but there was a dollar roundtable we had yesterday, and one of the key questions that markets people were debating is there already a risk premium from populism in the dollar? Are markets trading this kind of political risk and populism, or no? And where are we on the dollar? Anyone want to opine on that?
If I knew that, then I think that I could then have high conviction in all my 12-month investments, because that is by far the most, it's principal component to all investing. And when we think about the dollar, we've heard from Robin, what does the dollar mean? We think about the dollar versus G10, we think about the dollar versus emerging markets. And how I think about the dollar, I think what we have to understand is looking at it's the marginal return on capital. And we think about the flow of capital through the world and the pricing of that. And we think about the prospects going forward, it all comes back down into just all of these decisions that we're seeing being undertaken, both fiscal and monetary. And we think about the adjustments that need to be made, and to think about just how we are pricing global liquidity. And so there's certainly ways that, the headwinds that are facing these markets are apparent. And they're ones that are certainly justified by just where we are from a business cycle standpoint, where we are from a structural standpoint. And I do think that a lot of the issues that we're facing here are much less cyclical, but more so structural. And I do think it's misplaced that we're focused so much on the US economy and not about the structural changes that are taking place in the Chinese economy that's having reverberations around the world. And so to answer your question about with the dollar and the forecasting of that dollar means that we have to make assumptions on policy decisions that have not yet been made. Look at the adjustments that have been made this morning just with the announcements regarding Brexit.
Right.
And so I think that this is one where we have to kind of combine all of these together, and ones that we think about in terms of where we stand today. I think that I feel heading forward much, if anything, I would say that I feel like there's been an easing of this risk, easing of the concerns that I have on a global macro perspective. And I think that what we're starting to see now is just going to be more relevant for sentiment and the sensitivity of the pricing to that sentiment than of substance.
Maybe quickly on the dollar, Rob. And I mean, we've been talking about this dollar trap stuff forever, right? And I think the reality is there's no real substitute. The only two candidates are the Chinese yuan and the euro. The Chinese yuan's not convertible, full stop, and the euro doesn't have enough Eurocentric assets to be able to really challenge the dollar. It's going to be in kind of a second place in terms of the global risk averse or risk-free currency. And then populism in the U.S. has taken the luster off of the U.S. in maybe absolute terms, but in relative terms, we're still back in that trap where there's no alternative. So we're still in a very dollar-dependent world. It's hard to see that changing very much. Right. And I'm not a currency strategist. I work for a rating company, so I can say stuff like that. But I mean, I just don't see any near-term prospects for going to a different world in currency.
But there is the case that if looking at the relative growth rate of the U.S. And the fundamental role of the dollar, you would have thought the dollar should be stronger than it is now.
Right.
And so, in comparison to where, quote, quote, it should be, you can say there's a risk premium or political premium. Mm-hmm. You can also say that this is where the rising debt ratio and deficits start to weigh on the dollar. And let's just suppose Brexit gets done and the Germans decide to do some spending on climate change. They won't call it fiscal, but they'll call it spending on climate change. That could really change the dollar-euro quite significantly and quite rapidly.
So everyone, see what Catherine did there? She did something that all economists do. She made the counterfactual, right? And Brian, did you want to add to that?
Well, I think I have a pretty different view on the dollar, which maybe highlights just no one really knows anything about the dollar. But I mean, we see the dollar as relatively strong, especially given the way interest rate differentials have evolved. Yep. So, relative to some short-run fair value models, we have it 5 to 10% strong. Right. I think that's arisen in large part because there has been flight into U.S. assets in this uncertain, macroeconomic environment, and so going forward, I think I'm mildly bearish on the dollar over the next 12 months, given where it's starting from and given the prospect that if things did get worse, the U.S. rates have a lot more scope to fall than than foreign rates.
Right, got it. Paul, softball question. Can you explain this whole trade thing to us? Where are we going?
That's a softball question.
Obviously most people talk in terms of escalation, pause, or de-escalation. But in the end, there's obviously political and election calculus here. We've got these elections coming up. In the end, I think everyone appreciates, including in the White House, that trade frictions could mess with the economy and sentiment. Mm-hmm. What's your expectation here? Are we kind of, into the election next year in a holding pattern now vis-a-vis China? And if we are, what does that mean for other trade relationships, notably Europe?
Okay, well, first of all, we've argued for quite some time that this U.S.-China spat is less about trade and more about technology. So trade's kind of the bright, shiny object. I think if we just go back to the beginning of the so-called trade war and the U.S. complaint that they were running a bilateral trade deficit with China and an overall, I would guess, trade deficit and current account deficit. The way to fix that is to save more, and then tax cuts would obviously be going the wrong way. But I think the real tension with China is around technology, and a couple of reasons there. One is we've had long-standing complaints, as everyone knows, about intellectual property protection, level playing field for foreign firms, Chinese acquisition of technological assets abroad, and those things, at least initially, were part of the justification for the tariffs. But I think more importantly, what we've learned over the last 18 or 24 months is that China's actually much more vulnerable on the key technology front than we had thought earlier. We've got some research where we look at the Chinese tech industry and go up the supply chain, and after a couple of steps up the supply chain, you're looking at U.S., European, and Japanese, Korean firms. So if the idea is to manage the rise of China more appropriately, make sure the incentives are okay, the Chinese have every incentive to come to the table to discuss technology, because over the next decade, Chinese growth is going to be driven by technology and productivity, not a rising labor force because their labor force is shrinking, and not further accumulation of capital because they've gone through a debt-fueled capital accumulation boom. So the Chinese need to be able to access Western technology to drive productivity, to drive growth, which is the social contract they have with their population. So there's very ample scope for the U.S. and China to sit down and work this out. There's incentives on both sides. The soybean farmers in the U.S. are probably wondering how they got roped into all that stuff. That's probably a very good question. But if we get to that endpoint, to close the circle on this, Robin, we're going to need something on trade. Again, trade is optically important, trade's politically important, but since we're all being a bit doom and gloomy here on the panel, if there were a way to pivot away from trade, declare victory, and we could put the adjective tremendous in front of that if you want, and then focus on this actual sort of tension with technology, I think that would be a good outcome. But I think you're right. In the short term, we're going to get some noise around trade and declarations of victory, but we really need to pivot into the technology question to resolve this.
Catherine, what do you think? How do you see things playing out?
So I don't want to be the doom and gloom person here, but I don't see, so no, what we like to do is Venn diagrams, right? There are the various players, and you look for how that can kind of create an agreement in the middle. And I do agree 100% that the trade is, the trade strategy, the current policy strategy is inappropriately designed to meet the original objectives, which were the Section 301 issues on, the intellectual property and the technology and so forth. So the Venn diagram, the players in the Venn diagram are the best deal ever, and then there is the Chinese agreeing to something that is called the best deal ever. And then there is, since next year is an election year, and the surveys are very clear that everybody is, all voters think bashing China is a good thing to do. And it has changed very dramatically in a short period of time. Excuse me. So the third circle that we're trying to create a Venn diagram out of is the Democrats. And so it's very hard to see a deal that is the best deal ever, that the Chinese can sign, and that the Democrats will not go after. So where is the overlap that represents something that can be signed between now and then? We don't see that. We don't see that, and we don't classify some agreement on soybeans as a deal.
Right.
So
Totally.
continued uncertainty. The technology is at the center of it. That has overriding national security objectives that have become very dramatically interpreted. It is not just the trade, it's the technology, it is investment. And as you know, it's now being interpreted in terms of capital flows. Cross-border capital flows, not just into certain industries, but with regard to potential listing issues of firms on U.S. exchange and U.S. firms abroad. So it's metastasizing as opposed to being kept under control.
Gotcha. Brian mentioned something which I think on the dollar, which I sort of agree with, which is that, on most conventional models, the dollar looks kind of expensive, and in particular so against emerging markets where it's really off the charts. But for people who have tried to express bullish EM views, it's been a very difficult 2 years. And so in discussions with clients, the bearish camp basically talks about, well, we've got all this protection stuff going on, so that's obviously a big negative for EM. But then we have underlying structural changes, right? We've got 3D printing of shoes and so on, so low-skilled labor and wage arbitrage, which powered globalization for the last 2-3 decades, right? It's just changing. And so perhaps we have a re-rating of fair values in emerging markets. So Heather, I wanted to, you do a lot of thinking about emerging markets and new technologies, and we talked about data as a key driver of growth. Who are the winners if you look over a longer horizon emerging markets, and how should investors position?
So let's take this from the top, right? And so we're talking about the trade tensions, and we think about why these trade tensions came about. And it started back a decade ago when we start to see this structural slowdown and the decline of import growth from China, and as you've seen it slowly go into the US. And so what you've seen is the major economies becoming more and more closed, which has become very problematic for a lot of emerging markets economic models that are all predicated on this US-Chinese demand. We saw the big hit to emerging markets happen in 2016, where within the EM complex, it was actually divided into two. You had the commodity producers go into a sharp recession, where you had the EM manufacturers staying relatively resilient, kind of muddling along. And then in the third quarter of 2017, you started to see them all start to fall. You saw the DM market starting to also moderate that growth. And that growth moderation, has continued and in fact has started to accelerate for some because it's been amplified by the trade tensions. And so when we think about these changing in economic models, then what is one country's competitive advantage? When it's no longer low wages, then what is it? And what I've actually found is that it's becoming more and more relevant, and just explaining the differences within one's country and the prosperity within different regions is electricity costs, and a significant, competitive advantage is low electricity costs because of this shift that we're seeing, moving away from tradable goods to trading data. And so we start to look at just the industries that specific countries and regions have been able to attract, often is tied to that. And so when you think about the winners and the losers out there, I mean, you look at those low electricity cost producers and also pricers, right? You look at Canada, you look at Scandies, you look at even at Turkey, and whether or not they're going to be able to capitalize on that, and whether or not that's going to be able to translate into increased investment. So far, the data, I mean, I'm looking for those green shoots, and it's hard to find. I mean, there's some, private credit growth starting to pick up in commodity producers, but are we going to see that in the manufacturers? And is it going to be tied, to this structural development that I've identified? It remains to be seen.
So we are close to the end of our time limit, so I just want to finish with a bit of a lightning round, and maybe we can start with Brian. Brian, when you look out, what is the key risk that you are worried about? What maybe is off the radar that people are not paying attention to, and what should they be paying attention to? And since you all have been a bit of a downer, and my anxiety level is definitely up and rising, what are some good stories out there that you find compelling, right? I mean, everyone's down on EM, everyone is down on the overall picture due to indebtedness, so is there a positive story out there?
Okay, so maybe the thing not on people's radar or a meaningful risk, which won't help your sentiment, is, the thing is when we have recessions, they are 90% outside the model, okay? The model, when you have a situation where businesses are weak and you're worried about household spending falling, and you have a period of time when you have, the divergence and part looks good and part looks bad, there's obviously spillovers in the model that will generate, a downturn, but those aren't that strong. So my point is we don't understand significant economic downturns very well. That leaves you in a pretty uncomfortable situation that when expectations and sentiment feels fragile, and when some parts of the economy aren't doing well, essentially you're looking for a breakdown in the models, and those can happen rapidly. They happen through sentiment. So I think that's the situation that we find ourselves in terms of what we're watching and the risk we worry about. The risk we worry about is just sentiment and everything breaking to the downside at a time when there's limited policy space to respond. What's good news? I don't know. They fixed the repo market.
Oh, thanks, Catherine.
So, my good scenario, my positive scenario is first, I think it's important to note that throughout this entire year, the markets have underestimated, particularly the bond market, has underestimated the strength of domestic resilience. And I think it's because they have underestimated the levels, or they have not incorporated the level of employment. In other words, the historically low unemployment rate, rising wages, and increasing labor force participation, right, not just in the U.S., but in other countries as well. So the market has underestimated that strength constantly throughout this year. And so that could still be true. I mean, we can still go through with that and continue to have underestimation of the strength of the domestic resilience. The second thing is, I do think, there's possibilities here that we're going to go do okay on Brexit, and that there will be a pause, even if there's not a deal, there's no Venn diagram, that there will be a de-escalation of rhetoric on China, at least for the next 6 months, right, at least until a year from now, because that's when people start to make decisions about voting. And so that will provide a pause. And the third thing that I think, again, the market has not incorporated at all in its analysis, the potential for a little bit of an inflation surprise, as the market, as firms decide to use this time to pass through some price increases.
Got it. Heather, give me something.
It's a fixed income panel, so you're not going to get a lot of optimism, right? And so, but what I would just say,
This is not going in the good direction.
But from my perspective, there's always uncertainty, right? And the upside is that in some markets, in some asset classes, I think that you still are being compensated for that uncertainty, right? Well, yes, spreads are tight in selective investment grade credit, global credit, but when you look at interest rate differentials, right? The interest rate differential between emerging markets and DM is a historic, 20-year high, right? You look at short rates, right? You're getting a pick of 6%. You look at longer-term rates, 4.25%. You're seeing inverted yield curves in EM, not because of recession risk, but because of expected policy easing. You got 3/4 of the world's GDP undergoing policy easing right now. So rather than them tightening, liquidity conditions, they're easing these conditions. And whether or not they can capitalize on this and whether or not we can see a turn is one where I certainly feel a lot better than I did 12 months ago when you're seeing them heading in the opposite direction.
Thank you. Paul, final word.
I'm going to try to make you happy, okay? I think there's some upside potential around all this climate awareness and uptick in sort of green finance, green spending, ESG. We're seeing a lot more awareness of ESG on the investor side and on the issuer side. We've got a Green New Deal from Germany that will start to stimulate a bit of demand. I think just the whole awareness thing is going to do a little bit to kind of pump up aggregate demand, which has been missing, and a little bit of maybe momentum in the markets. I don't know how big that is. I haven't done the work on how to put that in the context of global GDP, but I think that's structural. It's going to be with us for a while and should give everyone an uplift.
Great. I want to thank the panel. We have a great panel coming up. Thank you very much. Give everyone a hand.